Welcome to the Ask for the Skinny podcast with a guest. I'm proud to present Dan Passarelli. Dan, welcome to the show. Please tell us more about yourself. What is your story?
Peter, thank you so much for having me. So I grew up in the suburbs of Chicago, and I'd always been interested in finance. Just money trading, that kind of thing. Just always, I don't know. I was just always interesting. So went to school in Chicago and got a degree in finance. And one of the things that I used to do when I was in school in Chicago is the university that I went to was about a 20-minute walk from the exchanges. And so on breaks between classes, a lot of times I would walk to the exchange. And this is a long time ago where you could just walk up to the visitors gallery. And I would just watch in wonder at what goes on down there? What are they doing? What's all the yelling and screaming about? And I found it so fascinating that after college, I graduated, and the very next day printed up a bunch of resumes. I knocked on every door of the Chicago Board of Trade building, and got a job as a runner, which was totally entry level. I was making $9,000 a year. So yeah, not a whole big salary, but I just wanted to check it out. I didn't really realize that that a regular kid from the suburbs could become a big trader on the trading floor. I just thought I was going down there to have an interesting experience, learn a little bit that could teach me something for some career that I'm able to have. But it turns out that there are a lot of people who will back traders. They'll give you money, and it's a pretty simple deal. Like, here's money, go make more, we'll split the profits. And long story short, that's what happened, and ended up being a trader on the trading floor for a long time.
That's fascinating. Just for our listeners and viewers, you said there are a lot of exchanges in Chicago. Most of us, when they think of exchange, they think of Wall Street in New York. Can we talk about the differences between Chicago exchange? Because in Chicago, there's a lot of exchanges, trade commodities and different stuff than New York. New York is mostly specialized in, let's say, papers or bonds and stuff like that. Can you tell us a bit more about the differences between New York and Chicago?
All right, I'm going to try not to channel my inner history nerd because I am a history nerd. But trading in New York came up because of basically all the Dutch immigrants. I mean, the first name of New York was New Amsterdam, right? Mm-hmm. And that's where the first exchange was in the Netherlands. So they ended up forming this stock exchange there. But then, there grew need for other types of exchanges because just feeding a population, getting corn and soybeans and beef delivered, there are contracts involved. And because of where Chicago is on the map, going through the St. Lawrence, channel there and through the Great Lakes, Chicago was a big hub for, waterways and railroads, and it became a huge hub for commodities in general. So that's where a lot of this business was done to begin with. So they started the butter and egg exchange. Oh, geez, a long time ago, early 1800s. And that gave rise to forward contracts and futures contracts, which eventually gave rise to options. So, yeah, we think of New York as the place for the exchange and for trading. But when it comes to derivatives, commodities, and futures and options, Chicago is a much more important capital for that.
Okay. I know that's why I asked about it, and I appreciate or I did a lot of trading, and because of the commodities, we did most of trading in London, and but we were always looking at there are also multiple exchanges in London, and we were also comparing to Chicago prices. So if there was an arbitrage to be made, that was London to Chicago was always there was a split usually, either negative or positive, and we could trade it against it. That's why I'm asking. So you become a trader, and what do you do now? Where do you channel your energy these days?
Well, a lot of places. I mean, you can take the guy off the trading floor, but you can't take the trading floor out of the guy. So I do still trade every day. I'm looking at the markets in some capacity. But in 2005, the Chicago Board Options Exchange asked me to teach classes for them.
Mhm.
And I wasn't sure if I wanted to do it at first. I figured, there's those who can do, those who can't teach. Do I really want to teach? But when I agreed to do it just to try it out, I had people for the first time like thanking me, like saying, "Oh, I never understood this before, and now I get it. Thank you for helping me." And I just found that to be really rewarding. And so, really, ever since then, my main focus is to help individual and professional traders, but mostly individual traders, fulfill their dreams and reach the financial freedom and financial goals that they aspire to. My passion really is for sharing the knowledge that I got down on the trading floor.
Okay, so I'm gonna start with prejudice, if and please give your opinion of it. Most of Americans still believe that being a trader looks something like the Wolf of Wall Street. Uh, how much of this is true? What's the percentage of the traders that act and live like the Wolf of Wall Street?
That's a funny question. Well, I'm not going to lie, there are some. um, and I mean, we can break that down in a couple areas. One, the character of the Wolf of Wall Street had some morality issues.
Okay.
And in any business, you get some of that. And the financial media loves to glom onto that. If it bleeds, it leads. But that's an extremely small minority of what goes on down there, especially because we were all in the same physical environment. Like, we got to know each other and we had to rely on each other. And, there's a saying, "My word is my bond," which is actually printed on the door of the New York Stock Exchange. And there was a lot of trust and support and camaraderie. That was really the norm. And that was really, really special. Where, if somebody makes a trade, the way they make a trade is they say sold. And everyone sees that trade. If that person's doing something wrong or illegal or something, everybody knows. So that really was that was the norm. People doing the right thing, people supporting each other, people helping each other. It was a real sense of community, and it was a wonderful career to have. Now, as far as the other side, the Wolf of Wall Street, the crazy parties and stuff like that, I'm not going to say a word about that.
Okay, your mouth is sealed. But I will push you a bit into the same direction. You said when you were on the floor, sharing the floor, there was a camera ready, and you had these special bonds because you needed to trust each other and know when to buy and when to sell and all this stuff. But
Yeah.
right now, um, we know that the majority is going on online. And
Yeah.
how did that influence the community? That is important.
Yeah. It's funny. I would attribute a lot of my success to have had that community. If I didn't have that community, I don't think I would have been successful at all. And so now that a typical individual trader, sits in their home office in front of their laptop alone, it's so hard for individual traders these days.
Mhm.
So in 2008, I started my company, Market Taker Mentoring. And one of the most important things to me was to build that sense of community, to make sure that we have a chat room where people can talk to each other and have that community and share these ideas. And we have our group coaching class every day, and it's like the same folks getting together online and chatting, asking questions of the coach who leads the class. So that sense of community is so important, and that's what I try to bring to people because it's hard to get. It doesn't naturally occur. Someone has to create it.
Okay, I have another question. Right now, everything is about AI and AI trading, and we read all this stuff. And I would like to ask you, what's your take? Is intuition more important than math and data?
Ooh. Well, we could have like a 10-hour conversation on this. Um, this is something I spent a lot of time thinking about and reading about and trying to figure out. I would say uh, math and data and logic and discipline, a system, is the most important thing in trading. Now, you chose to use the word intuition. So if you study a lot of like neuroscience, and I don't have a degree in neuroscience or anything. Like I said before, I'm just a nerd and I read a lot of stuff. But if you study neuroscience, like your gut is your second brain. There are more nerves that come together in your gut, second only to the ones that come together in your head. And like your amygdala and hippocampus, like they tag experiences to emotions. And like, you might maybe you're walking down a street and you kind of have the sense of fear and you don't know why. And maybe it's because when you were 2 years old, something scary happened then, and your 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 limbic system tagged that with fear. So intuition, like on the surface, can be a bad thing for traders, but intuition really is just sort of a heuristic, sort of a shortcut in a lot of ways to taking the things that you already know in your subconscious and just having your brain tell you because it's all sort of tagged information. So there is something to be said about intuition. Uh, and that comes from experience. And you can't I, it's hard to train a computer to have experience. In a lot of ways, that's what AI is. They scrape data off the internet, and that's the experience of millions of people over, tens of years. So it's a it's a hard question. It it's a complicated subject, my friend. It is a complicated subject.
But when you trade, you said that you're still looking at the charts. When you
Yeah.
trade,
Yeah.
do you rely solely on the info, or you rely also on your gut?
I I try to rely solely on the info. Uh, does my gut ever factor into it? I'd be lying if I said no, it never factors into it. It does sometimes, but I try and keep it very, very left brain, very, very logical, and keep emotion out of it as much as possible.
Okay. When we were trading, we often got in trouble with the regulators because there is a thin line between fast info and insider info. Where do you draw the line between fast info and insider info?
Well, the faster info you can get, the better.
Mhm.
Um, to me, if someone comes to me and says, "Hey, I work for this company and I know that the company is going to announce this, nobody knows this, but tomorrow everybody's going to know this." That's insider information. And I just don't want to I don't want to have anything to do with that. That's you know, if you work hard as a trader, you can make really, really good money doing it the right way. And so, it's not worth to me that. But, getting the fastest, if you can get public information before anybody else, that's public information. That one I'm all for. There's value to that. And people pay a lot of money for it too.
Yeah. And then I would like to know your take that most traders, probably the ones that were not educated by you, but most of them make less money than ETFs. What's your take on that?
Oh, yeah. I mean, I think that has a lot to do with human nature and neuroscience as well. I mean, look, true, like, I mean, first of all, if you take any profession, there's a lot of people who are just phoning it in. They want to do the minimum, work their 8 hours, go home, see if they can get away with extra long lunches, do the minimum. And with something like trading, it's more of a challenge because you don't have a boss that says, "Hey, you weren't back from lunch at 1 o'clock. Where are you?" If you're a trader and you just want to blow it off and have a 2 martini, 3 martini lunch, you're allowed to, but you're not going to trade very well. And so I think a lot of people, well, one of the things that attracts people to trading in my experience is you can make as much money as you want to. I mean, you can. Doesn't mean tomorrow I'm going to make $1 million, but it does mean if I put in that effort and really study and try and exercise a lot of discipline and grow my capital or leverage, I can get there. But a lot of people are just not born with that discipline. Not born with that discipline. They're not born with just that wherewithal to want to put in that effort because, I mean, look, I try and make trading as easy for people as possible, but trading's hard. Trading requires work. With anything, you get out of it what you put into it. And I think a lot of people just don't put enough into it.
Okay. Another question that I have to ask as a certified risk manager is, where do you draw the line between calculated risk? We know that risk is a must. If you want a profit, you have to assume risk. But where do you draw the line between calculated risk and gambling?
Ooh. So this is also a subject that I've spent a lot of time in my own mind on. So I think I have a different take on this than a lot of people. Trading is gambling. All right. Trading is gambling, but trading is educated gambling. Good trading is gambling with an edge. So you go to a casino, the casino doesn't care if you bet red or black. The casino doesn't care if you hit on a 16 or not. They know that they have a small edge on every single game, and they're willing to just play that game because they know in the long run they're going to win. Now, that's kind of the exchanges. That's the market makers, liquidity providers. Individuals, even at a casino, can learn to count cards. Casinos don't like that, but it's legal. Individuals can have an edge over the casino, and they're still gamblers, but they know that the more they play this game, in which they'll have wins and losses and wins and losses and wins and losses, eventually they win. So to me, it's all edge based and it's calculated risk, but let's make no mistake. It is akin to gambling. I was reading a book, what is it called? A Man for All Markets by Edward Thorpe. And one of the quotes he has in there is, oh shit, how does he put it? I think he says, gambling is a simplified form of investing. There's a lot to it. Gambling, it's just a lot easier to calculate odds if that's the kind of career path you want to go down. Trading, there's a lot more moving parts.
Okay. Another thing that I would like to test with you that we used not as a strategy, but as a tactic, let's say, buy on rumors and sell before the results are announced. Is that still true?
It does tend to be true a lot of the time. I do, it's hard to remember because you have these heuristics like recency bias and that kind of thing. I feel like it's not quite as true as it used to be.
Okay.
But I think that there still is something to that. And, you want to calculate the risk when you're doing that, of course, as well. But I mean, if you can get sort of ahead of something and have that insight before others, like that's an edge in and of itself. Like take, right now we're recording this in late November, right? There was like the Trump trade is what they called it. Still call it, I guess. And that was a lot of the industries that the market believes Trump will benefit because of things that he said. And as soon as it was clear that he locked in the election, those stocks and those industries, they really, really took off. Now, the policies are not even in place yet. And, maybe Trump will follow through. Maybe he won't. He probably will, but who knows? So that is kind of really, if you think about it, buy the rumor, sell the news. Nothing happened yet, except a guy got elected who said, I'm for these industries. And so they took off. And we had a pullback since then. So I think some of the smart money, well, they bought the rumor and then they still sold the rumor after they made money. So I think the markets and market participants have just gotten smarter and smarter over the years, and the game does get a little tougher and tougher.
Okay. There's another strategy that one of my acquaintances in Switzerland, he was mostly traded New York. He said, I'm leaving on the May 15th and I'm coming back on September 15th because during the summer, the liquidity is lower and all I do is minus. So I better save enough money for my yacht. So, so that was his strategy. So we could only visit him in Monaco or Sardinia or there because from the 15th of May till 15th of September, he was not trading. And he would liquidate all his assets on the 13th, 14th, and the 15th. And he would only enter the market on the 15th of September. How would you comment? Is there any historical evidence that this could be the right strategy?
Yes, the old sell in May and go away, right?
Yes.
It is a commonly observed thing. And in some ways, it's a self-fulfilling prophecy because what creates liquidity? Liquidity is created by more people trading. And if people think that, hey, after May 15th, there's going to be fewer people trading, so less liquidity, I might as well not trade. I'm going to go away. Well, then there's fewer people trading. And consequently, I've never seen any hard numbers on it, to be fair, but I think there is probably less liquidity during those summer months. So yeah, I can see that. I personally still do trade during the summer. If I'm on vacation, I try not to have any positions on, but there's probably something to it.
What's your take on the trading bots?
Oh boy, you got some good questions, Peter. Holy cow, man! This is a fun conversation. Whew, well, there's positives and negatives, in my opinion. I do believe that not I do believe, I mean, it's true that many of the trading bots are designed to front run orders, which is bad for the market. Now, that being said, those orders that front run other orders, and front running is something that is considered illegal, though the SEC allows these bots that do it. Front running in that capacity with bots, this is the Flash Boys, high frequency trading kind of thing. They're trying to make a penny or two, right? They're not like, trying to make 10% or something. They're trying to make a penny or two, but they're trying to make it tens of millions of times over and over and over again. And that adds up to a lot of money. So the individuals who are negatively impacted, the rest of the market, they are negatively impacted, but they're trying to make 10% or 20%, or they're trying to make not pennies, they're trying to make dollars. And so they don't really notice it. Now you could say, well, still it's unfair. They're getting shortchanged, and that's true. If you say that, that's true. But it's not very material. Now, the other side of that is back when I started trading, if I wanted to make an option trade, I was paying, $49 a trade. And that made it really hard to make money. Now, I mean, I don't know, I pay like 50 cents a contract or something, like 50 cents of like 2 quarters. The costs are so low because most of the firms have payment for order flow, which is part of what facilitates this whole high frequency trading. So on the one hand, these bots negatively affect traders a little bit, but in practicality, they positively benefit traders too with the greatly lowered commissions. So it's a complicated subject.
Okay. In the mid 90s, there was a trick in Wall Street to have server as close to Wall Street, so the exchange servers, in order to have better response time? Is there a delay on most of the, let's say, B-class trading platforms today?
Yes, the old latency question, right?
Yes.
Well, yeah, this is very related to what we just talked about. And those orders that front run and basically kind of steal a penny, like you want to pay $1.30, but it's a market order. You see it's $1.30, you think that's what you're going to get. They see your order before your order has time to get there. They get there before you, take 130, and you end up paying 131 and buy it from them. That's how they make their pennies. So, yeah, I mean, that still does exist. They did a lot of that with proximity, just being closer to the exchange, just faster. I don't know, my physics knowledge is weak, but what do you call it?
Lower latency, it was called.
Yeah, lower latency stuff, like not copper, but fiber optics or cable. I don't know what it is. Then they went to microwave towers. Remember that? In fact, you ever hear that story? Like it was one of the guys from Chicago, I think, he was a commodities trader, started a company and drilled a hole through a mountain so that the wires didn't have to go around the mountain. And then he started selling access to that route because it was, a couple milliseconds faster. Crazy. But as far as retail trader platforms, I mean, geez, I've looked at the settings on my retail trading platform, and based on the speed of your computer, you can set it to, just update things every 1 second or 3 seconds. I mean, 3 seconds might as well be a million years when it comes to high frequency trading. But, like I said, now I'm a retail trader, not a professional anymore in that regard. If it's a second delayed, I mean, if it's a really fast market, things are crazy. A second can still be an eternity. But most of the time, that's a very small impact. But yeah, I mean, my Thinkorswim is nowhere near as fast as somebody who, spent $1 million to build microwave towers to get their latency down a couple of milliseconds.
Okay. Another two questions before before we conclude. Leverage or non-leverage trades?
Oh, yeah. Well, my expertise and experience is in options. So most of the trades that I make in options, they are margined, though I wouldn't always necessarily equate that to leverage, although arguably I guess it is. Some people will, instead of buying 100 shares of $100 stock and paying $10,000, they'll buy 3 calls for $3 and pay $900, and they'll make a lot more if it goes up a couple of bucks. So that's a leverage thing to do with options. But if I'm trading like a credit spread, it's really a different way to think about it. But naturally, there is some leverage component. Let's reframe this subject a little bit and call it position sizing.
Okay.
Yeah. So position sizing is very, very, very important. I was just reading something earlier today I think there's a trader psychologist, Van Tharp, who had this game where he'd have a bag full of 50 marbles, and some of them had an L for lose, some of them had a W for win. And the odds were in your favor. There's more W's than L's. And he'd pull out one marble, and before he shows you, you would make your bet, your trade on that. And a lot of the traders would lose money because they would, they'd see three L's come up in a row and just assume, well, the next one's got to be a W, which of course is not true. And so they would bet bigger, and they would just end up serendipitously betting more on losers than winners. And like, doesn't make any sense. If you just bet the same amount all the time, if the odds are in your favor, you will win. So trade sizing is a really, really important thing. Arguably, the more edge you have on a trade, if you can measure it, you can bet a little bit bigger. But just starting out with a baseline amount, this is how much risk I'm willing to put into any given trade, which with options can be complicated. It's measured a lot differently if I'm buying a call versus selling a call spread. And to be very, very disciplined about your position sizing. It's really important.
Okay, so there is leverage, but you have to be careful about it.
Yeah.
And now, before we conclude, Warren Buffett claims that so in the short term, every day trader can make more money than he does. But in the long term, he knows only a few day traders that made more money than he did. What's your take on that?
Wow. We just had a mastermind in Chicago where we invited just like three of our like really top traders, the really smart folks. And one of the traders in the room said, well, it's easier to predict where a stock will be in 3 months than it is in 3 days. And I know that to be true because I've heard someone say that before. But the first time I heard somebody say that, I was like, how does that make any sense? That's crazy. But I believe it does make sense. And I believe that that is true. You get a great deal more volatility in the short term, and the short term is harder to predict. Good day traders can make money, and they can make money consistently, but they experience bigger swings, and they have a rising equity curve, as they say. But someone like Warren Buffett, who is they call that, well, I call it intrinsic value investing, where they figure out what the value of a company and buy it when it's at a discount and hold it. Yeah, apparently that's and compounding, of course, is a big Warren Buffett concept. I can see that. It makes sense to me. It sure does.
Okay. So before you close, is there any trick or trade secret that you can share with us?
I can. I have a very key secret, the secret to success. But the problem is it's really boring. Discipline, especially in managing your trades. So many traders focus so much on how to find the trade and to get into the trade. And that's very, very important. That's what determines your edge on the trade. But how you handle it afterwards determines whether you make or lose money. For me, as soon as I put on a trade, I immediately set my exit plan into motion. I'll put in a good till cancel limit order to sell, to take my profit if it becomes profitable trade. And sometimes that's take half the profits here, half the profits here. But I'll also set into action a plan to take losses if it goes against me. And sometimes that's a pure stop loss. Sometimes that's setting an alert. Hey, if I have a put credit spread and the stock goes down to the strike price, give me an alert, and then I'll close the trade or adjust it. So that discipline, especially on managing the trade, I believe is the key to success.
Thank you very much, Dan. Thank you for all these insights. Where can our viewers and listeners find you and get in touch with you?
Sure, Peter. So we are at markettaker.com. Market, like stock market, taker, like take what is rightfully yours, two T's in a row. Markettaker.com. And you can actually just go to the top right of the website and click on join free. And we've got some free classes there. You can access our chat room. You just have to go there and ask permission, and we'll grant it to you. And we're there to answer any questions that you have and to help as much as we can.
Okay, I'll include the link in the description. And thank you, Dan. It's been really incredible conversation. Thank you for all the insights for our viewers and listeners.
Yeah, thank you, Peter. This was really fun. It was a fun conversation for me too.